What's going on, YouTube? It's Dave's Daily Trades. I hope you all are having an incredible weekend. I know I am enjoying this beautiful weather that we're having. So in today's video, we're going to be going over a quick technical analysis for AMC and really going over everything that you need to know for Monday, which is just a few hours away. And guys, I am pumped for this week. Additionally, we're going to be going over the dark pool percentages on Stonko Tracker. We're going to be going on through phase 5 global margin rules that are coming out. This is some juicy things. And then lastly, we're just going to sum it up with some margin debt dropping and how this correlates in the S&P 500 and how this can actually give us a little insight into how the overall market is going to be performing in the next weeks and months to come. So without further ado, let's jump into the quick technical analysis for AMC and go over some price predictions. So of course, we have been watching this wedge shape formation that has really been panning out since, we'll call this early May. And this looks really, really good, guys. So of course, we have our touch points on this lower support line, quite a few, and actually some really perfect touch points. And then on the high side, guys, look at this. We have 1, 2, 3, and looking like we're going to retest our fourth attempt to break out of this formation here. So that is really good. But some bullish points because, of course, a wedge-shaped pattern, you can either fall down below, which happened over here when we were tracking this before, and, of course, we can break out to the upside, which really looks promising because of a few things. So looking at a technical perspective here, the big thing everyone's been talking about is this MACD crossover. We have our first green candle in the MACD crossing over, which shows the bullish reversal starting, and starting at a really perfect point, guys. This is really, really good, and especially to see us at $33, even the low point on this is just about, call it $30 even here. That's a really good area for AMC to have that MACD crossover. And of course, this is going to take a few days to play out and for momentum to start going, but we can expect in the next, I would say week and a half, this is going to be in full force. So of course, we'll wait and see how the market responds to this and how, of course, AMC responds for this. But of course, we're just going to cover a few resistance points that we can see in the next couple of days. So of course, this first resistance comes at $35, which we have been unable to close above for actually a few weeks since the start of August. So that's really interesting to see. And this level would be really the start of our bull run for AMC. Of course, moving up, $40 is the next point after 35. And I think 35 is actually going to be obtainable by Monday. We'll see how that pans out. But of course, once we hit that $40 mark, that's going to be our breakout area. If we do break out of this, we're going to be starting to fly through these next resistance levels. So that's what I'm watching. And of course, we have really the major points at 40, 45, 50, and then all the way upwards of 60. We don't really have great areas over here yet. So that's what we're going to be watching for the weeks ahead. Of course, tune in daily, guys. Make sure you're subscribed with the bell notifications on because I will be posting daily updates on this technical setup here. And of course, any news articles that are coming out and new regulations, of course, too. All right, guys. So that's all we really have, excuse me, for the technical setup here. Of course, RSI is just about at that neutral level of 50. Looks like we're just about flat now, but of course with this MACD crossover, we can see this continue to run up as well and correlate with the MACD. All right, so jumping into some news articles. So of course, Stonko Tracker. This is something I just want to point out because look at this dark pool percentage, guys. We have literally been in the high 60s and even have hit 70s in the past couple of weeks. So this is really crazy to see. And also seeing that the short percentage on the day is upwards of almost 60% this entire week. That's insane, guys. And it's about time that something happens because, of course, I know a lot of you have been freaking tired of seeing this stock price drop. But, of course, good thing comes. And, of course, as you guys can see all through the Discord chat, all through Twitter, Reddit, a lot of 13Fs coming out with extremely bullish information. I actually was reading something which I totally forgot to pull up today, that the Q2 whale stepping into AMC is ridiculous, guys. So, and sorry, I said Q2 meaning Q3 now because we are in Q3. So follow big money stepping in, and that is only going to help us, guys. So we'll see, of course, how the next couple of weeks play out, but I can tell you it is going to be extremely, extremely interesting. All right, so on Twitter, I have been following PB Jelly Games. He did a really, really good deep dive of all of the Phase 5 Global UMR requirements. So just want to take a brief look at all of this, what's going to be happening, and of course, this goes into effect on September 1st, 2021. But like anything, guys, there are going to be some preparation in the weeks to come to prepare for a lot of this. I would take this personally with a grain of salt. It's not going to change anything. And guys, all of the information posted in the communities, please take it with a grain of salt. It doesn't change our overall thesis on AMC or even GameStop, guys. So just going to go through this really quickly just to get some thoughts here. So what are UMR rules? This is uncleared margin rules. And this, of course, is going to take effect for all global financial markets. That's huge. And like I said, it's going to be in effect September 1st, 2021. But of course, leading up to this, there is going to be some things that hedge funds, market makers, banks, and all of the big guys out there are going to have to do to make sure they do not fall victim. So, of course, this does not impact the squeeze. Like I said, it doesn't change anything. This is just more information about what's going on behind the scenes, guys. All right, so UMR, uncleared margin rules, phase 5. What is this? The DTCC's automated margin call service. That is absolutely huge. So that means automated margin settlement service, greater need based on UMR. Pretty much essentially going through this is if you're not meeting margin requirements or you are risky, you're going to get an automated margin call right there, right away. So that is huge. And of course, more to come. And we're just going to go through the brief TLDR here. This article is jam-packed with information. I highly, highly, highly encourage you to read through this, but I did not want to have a 1 hour or 2 hour video going through all of this because it is some deep information. All right, so brief TLDR. Let's crank through this stuff, guys. So starting on September 21st, any U.S. firm that trades OTC, over-the-counter derivatives, must follow new initial margin requirements and in some case variable margin requirements. Of course, this represents Phase 5 of the BIS, Board of the International Organization of Securities Commission, plan for margin requirements for non-centrally cleared derivatives. This is big stuff. So Phase 5 impacts any U.S. firm that trades an average of $8 billion in derivatives. So, of course, your average retail or average even investor is not even coming close to this $8 billion mark. This is for giant whales out there, like our favorite funds, Citadel Securities. As we call them, Shitadel Securities, because they are shit. Anyways, so 1 through 4 that came out, and this has actually been coming out for the past couple of years, typically just impacted big banks. Phase 5 and 6 will impact funds and institutional investors, including hedge funds like our guys over at Citadel. If they meet the threshold amount of $50 billion aggregated average notional amount, AANA, in derivative trading, then they must comply with the new rules for initial margin requirements. So ANNA, the average amount of market-wide activity in derivatives in USD value that a fund trades throughout the year. So, of course, a lot of these big funds are actually going to be put into this because this is taking into account all of the derivatives traded during an entire year. Of course, just think about some of these funds that have billions upon billions upon billions dived into the derivatives market. And of course, that is why the entire derivatives market is overvalued and just flat out risky at this point. So that is really interesting. Anyways, the IM, initial margin required, is dependent on some variables as detailed far below, but the rule essentially works like this. And this is just a hypothetical example that we play out here. So firm A or B, A being the buy side, B being the sell side firm, meet the Phase 5 AANA first meet threshold level of $50 billion. They must follow the new IM rule. However, as an NISC, new in-scope counterparty, the funds making derivative plays, if the transactions per US UMR rules are under 50 million, then there is no requirement to submit the IM, initial margin collateral. Let's continue and assume that they are at the thresholds of 50 billion. So firm A, the buy party, wants to take a derivative position such as an options trade or a futures index trade. The trade occurs with firm B, sell party, as an OTC over-the-counter transaction. not a national cleared exchange. Example is the ISDA, as I know you all are aware of. So firm A and firm B are required, and this is the really interesting part. Firm A and B, guys, not just the buy side or the sell side, it's both parties that have to post the initial margin collateral for every derivative position that exceeds the 50 million versus their counterparty, and that collateral must remain in a segregated account. Example, both firms must put collateral of a certain amount, the IM, into a separate account in either case of the party defaults, which of course is failing. So why is that important? Why is it interesting? And this really kind of, I guess, throws shots directly at Citadel, and we'll read about why this is. So the segregated collateral accounts must have a separated entity custodian to manage said collateral accounts. For example, Kenny G, our guy over there at Citadel, cannot simply put the collateral in his Cayman Islands account and say it's segregated, as he would still have control over it. So essentially what you have to do is put this in a separate account with a new, I guess, overseer who would be that quote-unquote custodian who would have control over it and oversight of it. So important here. I personally do not know how many of the U.S. funds will meet these thresholds. However, the estimated from the ISDA suggests more than 9,000 firms will be affected by these new rules. So, of course, guys, that is really big stuff right there. And really what I take from this is, sure, maybe giant funds out there, even Citadel, might be able to bypass and be okay because of this. But the big thing is here, guys, there are a lot of smaller fish in the sea who are also way over leveraged in short positions in AMC and GameStop. So the big thing is Citadel has billions upon billions and possibly even trillions, for all we know, worth of money that they have in their accounts. Now, if we look over at these smaller fish in the sea, they are already struggling to get past this. And with new regulations such as Phase 5 coming out, they might not be able to meet these margin accounts. And especially talking, we have 9,000 firms out there. Citadel is only one firm that is short on both AMC and GameStop. So what I'm getting to here and kind of going down a little rabbit hole is, and I've been saying this literally since I started YouTube back months ago, is it's going to start with those small funds defaulting on their positions, which of course is going to create a domino effect because the price is going to rise and other firms are slowly not going to be able to meet those margin requirements, therefore defaulting, therefore putting more stress on the bigger players out there until all of those players default on those accounts and the stock goes absolutely parabolic. So guys, I do urge you to read through all of this. There are some really great links and other articles that you can even gather more information on, but just want to take a very high level bird's eye view look at what this is and what this possibly means. And of course, make some predictions because of this. But of course, like I've been saying, this does not change anything, does not change our thesis, does not mean Moon's going to happen tomorrow or Lambo's going to be in the parking lot tomorrow. It's going to take time. Just be patient out there. Now, the last article I want to cover with you all was over on Superstonks, posted by this user right here. And of course, like I always do, all these articles that we cover will be in the description section below. So check that out for yourself. Make sure you validate it and, of course, share it around to everyone. Anyways, guys, so the margin debt dropping after a big run-up. This is pretty much showing a market crash soon. And of course, like I always say, take this with a grain of salt. This is just going over data, comparing it to historical events that have happened in the past. But this is really interesting. So what we have here is in red, the margin debt. The gray is the recession periods, of course, having the 2001 dot-com boom and bust. And then, of course, the 2008 financial crisis here. And then a very brief gray line for the coronavirus pandemic that happened, which was just I would say a small correction compared to the greater scheme of things. So anyways, guys, so the blue line's S&P 500, red is margin debt. And looking back at 2001 and 2008, we're going to make predictions for 2021. So what happens here is, of course, we have a peak on margin debt. This starts to come down before the overall market comes down, as we can see here. We had this peak on 3/1/2021, and then 5 months later, 8/1/2020, 2000, sorry about that, guys, we start to have a sell-off. So this was just an early indicator of a market sell-off by margin debt coming down. And then same thing here. 7/1/2007, we hit the peak on margin debt, start coming down, and then by 10/1/2007, we have the market crash. Now, fast forward literally like 14 years here to 2021. What's happening? We hit yet another peak over here on the margin debt. Margin debt peaked on 6/1/2021 and since has been coming down, while the S&P 500 continues to rise to all-time highs. Now, if this does pan out, just like we saw on 3/1/2000 and 7/1/2007, we could really be seeing early signs of a market correction or even potentially a market crash coming, guys. So, like I said before we cover this, take this with a grain of salt, but I did want to show you how the overall market is doing and comparatively to AMC, because the biggest thing, guys, is AMC does have that negative beta, and quite a significant negative beta if I say so. So, of course, if we do have a market crash, a lot of investors are going to be taking their proceeds out of the S&P 500 or various other stocks with positive betas, moving over to that negative beta, which of course is going to bring in new investors to help out our cause. And of course, the big thing is market crashes and market corrections don't happen necessarily overnight. This is a decently long period of downward trading. So of course, lots of people are coming in, buying and holding AMC and GME because of that negative beta. All right, guys, that's all I have for today's video. Definitely be sure to hit that like button and subscribe, and I hope you all enjoy the rest of the weekend and rest up because we have some big weeks ahead of us. All right, guys, take it easy. Peace out.